Great. So I believe that sounds okay, and also you should be able to see this website, my screen here, which shows at the yen. But I'm going to start with the pound because we've obviously just seen quite an interesting development in the UK. We've had inflation fall, core inflation, that's when you strip out energy and food prices, fall to 2%, which is the lowest level since 2009. But even more importantly, it is at the Bank of England's target rate. So those of you who are based in the UK, like myself, will not be used to having inflation at the target rate. This is a big deal, not just because of how long it's taken to get inflation back down to the target rate, but also for monetary policy going forward, and of course the pound. And this is why we're looking at the 60-minute chart of the cable. As you can see, back below 152, currently around about that 151.80 mark. I'm going to show you another chart just to show you how significant this level is here, which corresponds with the lows from yesterday. I am a little bit concerned on the hourly RSI that we're looking a little bit oversold right now after that sharp drop, 50 pip drop after the inflation reading. Looking at it from a broader scale, as you can see, yes, just getting to this very important level. So it's no surprise really that we are starting to look oversold. Getting below 151.75 is going to be it's going to be maybe a bit of a trial, and I'll tell you why, or I'll show you another reason why. Because of this. This is the daily Ichimoku cloud. As you can see here, let me just zoom in on that. As you can see here, we are testing the bottom of that cloud, which comes in at 151.73, a massive support level there. If we get below there, it opens the way to kind of the 151.25, 150.70, and then of course 150, massive support level. Very, very important. Now, Adi has asked me to look at euro yen. I will, but I just want to finish what I'm talking about cable first, okay? So as you can see, very important level. A break below there is also very significant. Of course, those of you who follow Ichimoku clouds, they're actually, if you're new to FX trading, it's quite a nice technical analysis, aspect of technical analysis. It's quite a nice one to follow or to read up on and learn. There's lots about it. You can probably read it on the Forex, on the FX Street website, for instance. But what is also important, what is also important, good about this is that they're quite simple to look at. Basically, anything above the cloud is an uptrend, below the cloud is downtrend, a technical downtrend. So obviously, when you get to these clouds, when you get to the tops and the bottoms of the clouds, they become key resistance and support levels. So now we're testing this key support level. If we get below it, if we get below 151.75, it really opens the way for a downtrend in cable. So it really one could argue that cable is still in a downtrend if we just look at it there. This is just year to date. As you can see, the recovery has been quite shallow. But what it does do, if we do get below 151.75, is really negate the recovery that we've seen since the kind of first week of March, and that is significant. That's going to have significance for this market and for cable going forward. It's also going to impact some of the other cable crosses. Let's take a look at euro sterling. As you can see, euro sterling trading sideways, but actually you see it better here. Euro sterling, nice push higher, but we are just hitting that resistance zone. Let me just zoom in on that there. As you can see, nice push higher. This is the daily candlestick there. Really nice push higher after that inflation data. But we are approaching some key resistance, 84.95, which is a convergence of the 100 and the 200-day, the 100 and the 50-day moving average. Now, as you can see, the 50-day does look like it's just about crossed below that 100-day, but because of this move higher that we're experiencing at the moment, that's kind of not really in play. And if we break above this, if we break above 85 on the back of this data, then we may see that crossover just reverse itself. However, what we would certainly watch out for is, as we said, the fact that the hourly cable is looking a bit oversold now, so it might just limit sterling losses. just in the short term. So cable, as you know, sterling generally has been a big mover. I know someone looked at euro yen, but I want to just show you sterling yen. Again, just to show you, sterling yen hasn't really had too much of a move on the back of this. If anything, it's fallen, but it hasn't really broken too much new ground. But we do think sterling yen is possibly at risk of further declines because it's at such stretched levels. I mean, let's just take a look at this 5-year chart. As you can see here, we're at the highest level since 2009. Let's go back to the 1-year chart. That's a bit messy. So, you know, we're currently around about that 155 level. Just below 156. If we get below 155, it opens the way for a dip back to this level here at 152.50. So we do think it is a bit vulnerable, sterling yen, because of this kind of weaker inflationary pressure, which opens up the door to more QE from the Bank of England. And obviously, on a relative basis, people have just been concentrating on Japan and its QE. Its central bank meets tomorrow, and I'll talk more about that. But it's just a relative stance. The market will have to reassess the outlook for the pound now that inflation is so weak, and now that it looks like there could potentially be more QE on the ground. Yas has asked me to look at the Aussie. I will indeed, because the Aussie's been very interesting. But I think right now we'll look at yen. We'll look at yen generally, dollar yen first, and then we'll take a look at euro yen, because they're both quite tied in together. What we've seen with euro yen, as you can see, it's stalling. Stalling at these highs. 103.30 has been the high. That was the high from Friday. Since then, we've really moved sideways. There's a couple of reasons for this. We've had some mixed messages coming out of the Bank of Japan. So yesterday we had the economy minister come out and say that he thought the yen had weakened far enough, and today we've had another minister come out and say that they think that they were saying the exact opposite. They said that the yen could have further to fall. So you know, how do we take that? How do we read into that? Well, right now I think it suggests that, you know, the market it's a good excuse to take a breather because of this political rhetoric that's at either end of the spectrum. Now, added to that, the other reason why we might be taking a breather, why we might be backing off those 103.30 highs, is because we've got a Bank of Japan meeting tomorrow that concludes tomorrow. Now, it's not expected to do anything. Remember, only at the beginning of April, so not that long ago, they enacted a huge amount of stimulus. They expanded their monetary base to 270 trillion yen. Yes, that is 270 trillion yen. So that's a huge amount of monetary stimulus. It's not quite up there with what the Fed has been doing, but it's certainly much bigger than anything the Bank of England has done. So the fact is they've done that already, and it's a big deal. If you then see the Bank of Japan come out tomorrow and not do anything, well, a lot of people would argue that the markets are a bit addicted to quantitative easing. They're addicted to liquidity. And if the Bank of Japan doesn't give them what they want, even though it gave them a huge amount of what they wanted just a couple of months ago, then that could be, the markets might not take that so well. We've seen, Asian stock markets globally actually come off their highs, just back away from those highs. They haven't fallen at all. But likewise, we've seen dollar yen just again back away from those highs. Now that's very normal when you get to high levels, for a bit of consolidation to come in. But it will be interesting to see how dollar yen reacts when we get the Bank of Japan meeting, especially if they don't do anything. Now, there are some key support levels to watch out for. Let me just zoom in on this one moment. As you can see there, 102.75. Well, we'd look at 102.30. There were the lows from today. 102 as well as a big level, and then 101.80, which is just the bottoms here. So the intraday bottoms that we have seen. We still think that the dips are going to be picked up because we still think that the outlook is more hawkish for the Fed, and also a better economic outlook for the US right now. But we're cautious when we look at dollar yen now, especially as we lead up to this Bank of Japan meeting. So I expect, as we lead up to the Bank of Japan meeting, I know you guys, you're all traders, you're all quite You know, you're all, retail traders maybe, short-term in nature, you want actionable trade ideas. For us, you know, we are trading in a range in the next 24 hours until we get that Bank of Japan meeting. At 7:30 London time, we get Governor Kuroda giving a speech. So that range at the moment, obviously 103.30 on the upside, but really it's kind of 102.90-ish, or to 103.10, and then of course 102 on the downside. So that's the range that we're looking at. So Pan, you've asked if I can explain inflation, interest rates, and their impact on the currencies. And I will do that. I will definitely do that after I just look at yen, if that's okay, because it is important. Euro yen. So Addy, I know you wanted to look at euro yen. Here we go. Well, euro yen. Could there be a correction to 130? Was your question? Well, yes. Yes, there could be. And again, as I said, tomorrow's the Bank of Japan meeting. Tomorrow's a big day for the yen. It's also a big day for the US dollar, which I'll look at in a moment. But for the yen in particular, or first thing anyway, we've got this Bank of Japan meeting, and as I said, like, you know, if they don't give the market what they want, if they don't announce anything more, which they're not expected to, then we could see a bit of a knee-jerk reaction lower. But overall, I think the bigger, I think that could maybe disrupt gains in euro yen maybe, but I think really the bigger directional impact for euro yen this week is going to be Thursday when we get the PMI data out of the eurozone. So we get the first reading of May PMI data. We also get some German IFO data. That's really important because we do know that economic data moves markets and certainly moves the FX market in a big way. The euro is very sensitive to PMI data coming out of Europe, coming out of the eurozone, and it's expected to remain quite weak. However, if we get weak PMI data along with a weak German IFO report reading for May, then what we could see is a bit of a sharper decline in the euro, which could potentially also push euro yen down to 130. Now, I just want to show you the pivot chart. Pivots are just quite a nice way they're kind of, you know, they use moving averages, but they're just a nice way to get a grip on where the market is now. And as you can see, they're basically saying the daily pivot, is 132.10. So roughly around, we're only 20 points above there right now, so mildly bullish because we're above there. But, you know, we're trading in a very tight range with 132.76 being the top level of resistance, 131.50 being the downside support there. So we're kind of moving sideways, and I think because the market wants to digest the Bank of Japan meeting and also this PMI data. So I think really the Bank of Japan meeting, yes, it could cause maybe a knee-jerk lower in euro yen, maybe back down towards that 131.50 mark, maybe 131.25. But I think the bigger impact is going to actually be the PMIs. I think that's going to have an impact on the euro more broadly. And to show you that, I'm going to look at euro dollar as well. As you can see, euro dollar is pretty much trading in a range. Yes, it's weak within its range of the last couple of months, but it did find very good support at 128 and actually bounced off there. However, for us to get below this key resistance support level here, which goes all the way back to March, we think we're going to have to see, you know, there's going to be a fundamental driver for that, and that fundamental driver in the near term anyway is likely to be that PMI data. So that PMI data is released let's just have a look. I can bring it up here for us. It's released on Thursday at 9 o'clock London time. So for all of those based in London, 9 o'clock. If you're based on the continent, 10 a.m. And if you're based in the US, 4 a.m. So very early start if you're based in the US. But as you can see, basically anything below 50 suggests contraction and weakness. And the market, this is what the market expects here for the PMI manufacturing services and composite. As you can see, all sub 50, which is all very, very weak. Slight pickup from the month before, but if we get weaker numbers than expected, then that could really send the euro flying south. So Pan has asked me about interest rates. Now I haven't forgotten about the Aussie. I am going to go and show you the Aussie, but this actually fits in quite nicely. Fits in very nicely actually with what we've been talking about. So this is why I will I will touch on how interest rates impact the market. So this just is an illustration that interest rates do matter. So when I'm talking about interest rates here, I'm not talking about the interest rates that we pay on our money, or that we get paid from the bank or pay the bank. I'm talking about interest rates that the government get charged to borrow. So it's interest rates on government. It's interest rates on government debt. So this is the UK, this is the sterling dollar rate, so the cable rate, which is the yellow line on this chart. And then the orange line is the spread between government bond yields in the UK and the US. But actually you could take that away and even make it more simple and just look at and the reason why we do the spread, is because obviously we look at cable sterling against the dollar. So we're looking at the interest rates, the UK against the dollar as well, to get a good grasp of what this means. But you could simplify it further and just look at UK interest rates. But what we see here is you can see those that interest rate differential really follows what sterling dollar does. And the reason why is that interest rates are, they're what you get paid, they're what you earn on your money. When you get a high interest rate, you earn more on your money. That means that you might want to buy that currency because obviously you're earning more yield. Likewise, if you have a low interest rate, that means that the money is worth less, which also means that there's, you may want to sell that currency just to, if you're not earning on it, low yielding assets can sometimes be difficult to hold, right? You want to earn something on your money. So in this example, we've seen UK interest rates fall at a faster pace than US interest rates, which has also weighed on sterling. So it's meant that rising interest rates in the US have attracted buyers, which has helped push up the dollar. Falling interest rates in the UK have attracted sellers and has pushed down the sterling. So that's why we've had this decline here, one of the reasons why we've had this decline here in the pound. Does that make sense, Pan? I know that I hope that makes sense, but it's all to do with yield and how much you actually earn on your money, and that's how interest rates and currencies really intertwine. Now, inflation is important as well, because obviously inflation does determine interest rates. High level of if you've got kind of healthy inflation growing at a healthy clip, you might want to kind of, hike interest rates maybe just to make sure that inflation doesn't go out of control. Again, that can have a positive impact on the currency, but inflation can be a confusing, Pan. Yes, it can be, definitely. And the reason why, and I say that, rising inflation doesn't mean that it's necessarily good for a currency, because you need to have inflation that's rising at a steady pace, not a crazy pace, because that's very currency negative. But falling inflation is a negative though for a currency. It really is, because it can weigh heavily on inflation and weigh heavily on economic growth. Because if you've got falling prices now, people may say, do you know what? I'm not going to buy that now. I'm going to wait until it gets cheaper in the future. So it can impact on GDP. We also have it can also cause interest rates to fall, which, as I've shown, is currency negative. So as long as inflation doesn't get out of control, then moderately rising interest rates can be currency positive. Moderate increases in inflation, steady increases in inflation, which can suggest positive economic growth, can also be good for currency. So hopefully that makes sense. But this is just looking at cable. Now I want to just change this chart to look at Aussie, because I do know that Yaz has been waiting very patiently for me to talk about this. So this chart here shows Aussie dollar, which is the yellow line in this chart, and also the spread between Australian and US interest rates. So as you can see, that spread is at a real 12-month low, and we've also taken Aussie with it. That's also at a 12-month low. So just again another example of how the Aussie and interest rates, or how interest rates and FX move together. I also just want to, I'll take a closer look at Aussie as well. So as you can see here, the Aussie is been beaten up. Let's face it, it's really been beaten up. It's out of favour for a number of reasons. The RBA are cutting interest rates. As I said, the yield differential is, as I showed you just in the last screen, the yield differential isn't on its side. We've got falling commodity prices, and then all importantly, we've also got a very weak Chinese economic backdrop, and all of those things are just fundamentally, it means that Aussie's getting beaten up, basically. Very, very sharp fall. Do you remember, not that long ago, only in mid-April, we were up at 106. If you'd shorted the Aussie from there, you'd have made a nice, pretty penny. Now, the low that we're targeting, or the next level to watch, is 95.82, so about 200 pips from where we are now. Now, we could get down there, but there's going to be a few things that we're going to watch. We obviously, today the Aussie's been a bit up and down. We had some RBA minutes come out, but they didn't really tell us what we knew anyway. At the end of the day, they cut interest rates. We know what that means. What we're seeing as well, level average like it, how we've got set is holding us quite good support too. So is this a recovery? I'm not 100% sure. I don't think one up day is necessarily a sign of a recovery. I think it's going to be very dependent on a couple of things. Number one, what the dollar does. We've got some important testimony from Ben Bernanke, Chairman of the Federal Reserve, tomorrow. That's going to be really important for the medium-term direction of the dollar. Likewise, we also have Chinese PMI data coming out on Thursday morning. That's also going to be a key driver of the Aussie. So really, right now, from a technical perspective, it's quite difficult to see really where this is going. It looks like we're just consolidating. The market's taking a breather. There's certainly, is enough negativity priced in? Well, maybe not. Maybe this, we need to fall back down to these kind of lows that we saw, around about the 96 level. That would be a natural support zone. But right now, the market is taking a breather. So we're not getting married to any positions in Aussie because we want to see how the dust, which way does it go? What with the Bernanke testimony, if that causes the dollar to rally, then yes, the Aussie will be under pressure. But equally, if we see, and then added to that, if you get some weak Chinese data, PMI data, that would also be a very negative development. So Aussie Kiwi as well, I'm going to look at. And as you see, yes, the Aussie Kiwi is at a very weak level. The Aussie's been the worst of the commodity block performers. But interesting enough, do watch out for this, because as you can see, we're below 120, which is the key support level. We are below here, but Aussie CAD, which has also been very weak, has actually started to recover. So that's what I'm just looking at there. If we can continue this recovery in Aussie CAD, then it might feed through into a bit of a recovery in Aussie Kiwi. So there could be a short-term long in Aussie Kiwi there, maybe targeting that 122 level in the kind of next week. But I am watching Aussie CAD because the fact that that's been able to just recover a little bit suggests that maybe we're seeing a bottom in the Aussie. And then to finish things off, Yazaru said, what am I expecting from Ben Bernanke? I think he's going to sound concerned about inflation, but I think he's going to overall say that they're happy with the way things are moving. I think he's going to stick to the current Fed status quo, which is, yes, we could end QE3, but we could also add to it. I think he's going to be cautious, probably more cautious in tone than some other Fed members, and I think that's going to cause a bit of volatility in the dollar. I'm going to show you the dollar index right now. So I think that if he does sound concerned about inflation, as I expect, I think we could fall down. We could fall lower in the dollar. This is the dollar index, so the dollar on a broad-based basis. Very good support there at 83.50, and then below there 83. And I wouldn't be surprised to see 83 if he does sound fairly dovish. Likewise, as well, though, if he doesn't sound as dovish as expected, the level to be 84.50, and then that opens the way to 86. And obviously, a period of dollar weakness could certainly, you know, I don't think it's going to be permanent, but I think it will allow people to short some of the dollar crosses at better levels. So I think it'll be used as a buying opportunity, but maybe not for the next kind of 2 or 3 days. I think it could be a couple of days of dollar selling if Bernanke is particularly dovish, and that is going to be the key driver for the dollar, and also for some other for the dollar, but also for the wider, broader G10 space in the next couple of days. Okay, everyone, I'm going to go now. Thank you so much for joining. I do apologise for joining slightly late. I had a bit of a problem with my login, but thank you so much, and great. Please do join us next week for more. Okay, thanks, everyone.